The jobs report from a couple of weeks ago didn't just change the September 17th BOC rate cut odds. It exposed a $15,000 mistake that over 86% of Canadian borrowers are making right now with their mortgage terms. And most people have literally no idea that it's happening, which is why I'm going to explain it to you today and how exactly to avoid it. Right now, if you're choosing a 5-year fixed mortgage term, you might be paying over $15,000 more over the life of your term when considering other options. And this matters because the Canadian default is the 5-year fixed mortgage because, quite frankly, it feels safe. But the data from a couple of weeks ago basically supported and changed the math to show where the actual real value is. Now, before I get into the supporting data, which I will right away, there's two things I want to point out. Number one, this is not blanket advice. I will go through how we should advise on this information and how to take this information in this episode. And number two, this information is based on data that was readily available when I posted this information. So if you're watching this 6 months later, it may not apply, but the fundamentals will. So definitely pay attention as I explain to you how to make a decision after that information is in hand. Now, back to the supporting data. The forward rate expectations dropped dramatically after the job report. The markets expected the Bank of Canada's overnight rate to drop to an average of 2.4% over the next 5 years instead of the 3.1%. Now, the data that actually came up that people need to know about is that Canada lost 66,000 jobs. And here's the thing. Economists were actually expecting us to gain 7,500. That's not a small miss. That is economic carnage. And I've talked about this on a previous episode, so I won't get into too much depth. But essentially, this level of job loss forces the BOC's hand on rate cuts, which completely changes part of the way that you should consider different mortgage options. I'm going to show you these exact mortgage terms, which are quote unquote underpriced and which could be overpriced right now, and how to save thousands regardless of what happened before or after September 17th. Obviously, it's not about predicting if rates get cut. It's about understanding which mortgage lengths give you the best value on what smart money actually is. The way that we determined this information was based on professional bond traders who move billions of dollars based on this data, and knowing the fact that mortgage pricing hasn't always caught up. So here's what most people don't understand about mortgage pricing. Let's get into the breakdown. Your rate isn't based on today's Bank of Canada rate. It is based on what rate is expected to do. Now, when I'm talking about the rate, I am talking about fixed rate mortgages here. If you chose the 3-year fixed rate mortgage, the bank is pricing the rate based on a guess of what rates will average over those 3 years. And again, with that job loss information, that completely shifted the change of where those guesses are going to go. A 5-year fixed rate reflects the expected average overnight rate over 5 years, plus the bank's origin profit margin. That expected average just dropped from 3.1 to 2.4%, which is basically, I'm explaining to you the hidden mechanics of essentially mortgage pricing without getting into the jargon, like forward curves and Cora and all these types of things. Essentially, how it all works is like this. Professional bond traders, these are the guys who are moving the billions of dollars around. They immediately start betting as soon as they saw that job loss happen, that rates will be much lower for much longer. The overnight swaps dropped. The pricing changed. Basically, what I'm saying to you is this isn't speculation. This is money moving hands and showing you exactly where it's going. But here's the opportunity. Mortgage lenders don't adjust pricing every single day like the bond markets do. Typically speaking, they're slow to react, which creates a little bit of a unique window where you can get better deals in a market when you know what's likely to happen. And while some of this data could be a few days old and the banks could be catching up in the next couple of days, depending on when you see this, you could still react to that. And this matters because bond traders instantly reprice those expectations. But your bank is still using old information to price loans. And essentially what's happening is the gap between the fast markets and the slow lenders is where your opportunity is. In English, basically what I'm saying is that mortgage lenders typically lag behind the market by 2 to 6 weeks. Right now, some terms could be underpriced by 15 to 25 basis points. That's 0.15 to 0.25%. realistically, this is where the opportunity is, and this is where that cost, that mistake I was explaining is. So let me just explain why choosing the wrong term could cost you $15,000 on your mortgage. It's not theoretical; it's real money. On a $500,000 mortgage, being overpriced by 0.3%, it can cost you $1,500 per year over a 5-year term. That's $7,500 plus the compound interest, which brings it up to a total of approximately $15,000, depending on the amortization schedule, depending on if you're prepaying the loan, but just as a general guideline. Ultimately, this is the concrete numbers to be clear about. And when you choose a 5-year fixed mortgage right now, you're buying insurance against rate cut or rate increases that, although are still somewhat projected to happen, might not happen as quickly as is expected. And so you're buying insurance where you might not need it, and that is the price of the insurance. Essentially, insurance is valuable when the risk is real or realized, or you're someone who is conservative. And with unemployment being at 7.1% and the economy shedding jobs right now, rate increases are highly unlikely, at least for the near term. Now, there's a caveat to that. There is data that could support the alternative. There's a lot of things that could happen in the next 5 years. And that is why some people opt for the 5-year term to quote unquote buy that insurance at a higher cost. The Bank of Canada has never raised rates, just for stats, when unemployment is above 7%. Current economic data right now suggests that it's staying low through 26 and 2027. Basically, again, to be clear, I'm not saying the 5-year fixed mortgage is a bad product inherently. What I am telling you is that it's a more expensive insurance agent than what it could have been otherwise. Meanwhile, the 2 and the 3-year money is now priced assuming rates will be higher than smart money actually expects it to be. So basically, what I'm saying is that these shorter terms are accidentally underpriced right now because lenders have not adjusted fully to the new economic reality. And that is, technically speaking, where the saving opportunity is. Because if they reprice the markets based on where the rates were going, you would actually see those rates potentially increase. Example, the 2-year government bonds suggest that rates averaging 2.2% over the next 2 years, actually, these are the bonds, but the 2-year mortgages are priced at about 2.8% above the average right now. Essentially, what I'm trying to say, to make the math relatively simple here, is that you can save about 25 basis points by choosing a 2-year term and about 0.15% on a 3-year term when compared to a 5-year. And that works out to anywhere between $1,250 to just under $1,000 on a $500,000 loan. Now, that's never a good idea to choose a interest rate over a quarter point. Of course, there are things that can happen really quickly. But for those who are looking for the value play and flexibility, remember the advantage of the shorter term is, of course, the ability to exit in a shorter timeline, therefore reducing the likelihood of having the oh so scary interest rate differential penalty, which is key. Now, everybody's obsessing September 17th. You're going to watch, by the time you listen to this, it might be September 17th already. And people are obsessing right now over the cuts like they always do. And whether the BOC cut by the time you're watching this or not by 0.25% or hold steady, the fundamental economics will not have changed. The opportunity exists regardless of the meeting's outcome. And of course, things could change, but theoretically, it's highly unlikely. Even if no cut were to happen or does happen on September 17th, unemployment is still at 7.1%. Job losses are accelerating. And we know that the economy right now, it's weakening. Cuts are inevitable. They just may be delayed by 1 or 2 times. And yes, I am trying to remove the anxiety about trying to time the market. And I'm trying to tell you, focus on the bigger trends, because the real insight is understanding which mortgage terms are mispriced based on where rates are actually headed over the next 2 to 5 years. I want to go deeper here. Single rate decisions matter less than the overall direction, whether it's the direction of the market or the direction of your finances or your portfolio or the economy. If one of these term products makes sense to you, a smart borrower will make decisions based on a trend and not one meeting. It has to be, honestly, the biggest mistake that I think people make is they make a decision based on this one date in time, as opposed to what is my financial situation, what are my goals, what is the risk, and then what does the trend say? I really want you to think strategically and not reactively if you're watching this video. So let's say whatever reason they didn't cut. I mean, chances are they probably did, but like what if they didn't and rates stay exactly where they are for 6 more months? The 2-year versus the 5-year value comparison still heavily favors the shorter term right now. The 3-year, for that matter, even more so. Your strategy in picking your mortgage doesn't depend on perfect timing. No one does. Even in no cut scenario, you're better positioned with a shorter term in this case. If rates were to stay above the 4.75% overnight rate, or I guess 4.95% overnight rate for 6 months, then decline, the 2-year term still outperforms the 5-year term by 15 to 20 basis points. The 3-year, again, more so, depending on where that data lands. But here's my point. If they do cut aggressively, shorter terms could position you to take advantage of every potential rate reduction, while that 5-year term locks you into higher rates for a much longer timeline. Essentially, if the market tanks, if you take a shorter term, you do better. If the market doesn't tank, you do good, but you're paying a premium. And I truly believe that everybody going into a 5-year right now kind of knows that fact, but just in case they aren't. So here's the framework I use to help my clients choose the right mortgage term based on those market conditions. Instead of guessing or going with what feels comfortable, you can make a mathematical decision based on market data. And the framework has helped clients in my case, save an average of $8,000, $12,000 on the mortgage by avoiding overpriced terms in many circumstances, whether it be shorter or longer, and more specifically, making sure that they're not getting caught with nasty prepayment penalties. First, look at what the professional investors are betting rates will average over the potential mortgage terms. Now, I put some videos out on this fact, and I continue to do so, but these aren't predictions. They're real money bets based by people who get fired if they're wrong over and over again. So we're looking at government bonds, yields, 2-year, 3-year, 5-year terms, which show expected averages. Number 2, compare those expectations of what banks are actually charging for each term and length. And this matters because sometimes banks haven't adjusted their pricing to reflect the new market realities, which creates opportunities, you bet, for informed borrowers. Right now, the 2-year could be overpriced, and the 3-year is properly priced, and the 5-year is overpriced relative to the bond market's expectations. Number 3, factor in your personal situation. Now, I think this is actually number 1, but I'm just giving you a framework. Can you handle renewals at renewal time? There's a lot of people right now who definitely aren't prepared for renewal. Can you handle that? Do you need payment certainty? Are you planning any major changes in your life? Because then it makes sense to pay the premium. The premium isn't bad anymore. You're paying interest because there's an insurance associated with that. Math alone does not determine the right decision. Your personal circumstances matter, but you should understand the cost of prioritizing the comfort over the value. Clients who prioritize payment certainty pay an average of 20 to 30 basis points more for a 5-year term versus optimal shorter terms, historically speaking. And the fourth factor is make a informed decision, knowing exactly what you're paying for and why. There is no perfect choice, but there are informed choices. Understanding your trade-offs leads to better long-term outcomes and definitely more comfort in your decision. Clients who understand their decisions report, and this is according to a recent MPC study, I believe this one, they report 85% higher satisfaction at renewal time compared to those who just picked what they felt was safe. That's a key point. Higher satisfaction because you know what you did and why you did it. The 3-year term makes sense if you want a bit of more stability than the 2-year term, but you don't want to pay over dramatically for that 5-year term. The 3-year term is basically appropriately priced for what it is relative to the bond markets, and what I consider to be good value right now. It's not the best choice for everybody. It's good value. The variable rate makes sense if you can handle payment changes and want to capture every potential rate cut in real time. Like if you believe this market is going to tank, then yes, it makes sense. If the overnight rate were to drop 1% over the next 18 months, variable rate holders would save, on average $625 a month versus the fixed rate, especially on the 5-year fixed. They do quite well. What I would recommend here is avoid the 5-year fixed unless you absolutely cannot handle any payment uncertainty, or it's just going to help you sleep at night because it's not necessarily backed by data, it's backed by comfort at this point. Ultimately, today, at this very moment, depending on when you're watching this video, and it could still be the case, you're paying a premium for protection against an unlikely current rate increase. Even though the forward projection says rate increases are going to happen, this is what the markets are saying, at least now, based on the trend map. Now, the question is, how do you take advantage of this opportunity? The window for capitalizing on this mispricing opportunity is going to be pretty limited. Remember, 2 to 6 weeks. We're already probably a week and a half by the time you're watching this video. Lenders are eventually going to adjust their rates to reflect the new reality. And some of them already actually are, interestingly enough. Historical analysis shows that mortgage rate adjustments lag the bond market 2 to 6 weeks, which I mentioned many times. You need to get a pre-approval today or get locked in today if you can, and not wait for the rates to drop. Because the thing is, even if the BOC cuts rates and they decline, you need to still qualify at today's stress test levels. And if you do take a mortgage product today, and if for whatever crazy reason the market did decline, you can usually do a float down if you choose the right type of program, right type of lender, and you're proactive. And that actually is a huge mistake people make over and over again. They try to negotiate the best terms up front. They don't look for a float down policy, which is great in a market like this. Also, you should be working with someone who understands these dynamics and can help answer the question and help you navigate any type of term selection based on actual analysis and not just generic information. Here's a crazy thing. You want to hear a stat on the market, and this is crazy. Now, the mortgage broker market, I will attest to because I teach, I'm trained, I'm heavily involved in helping mortgage brokers. But here's the crazy thing. Only 23% of mortgage brokers regularly analyze forward rate curves according to industry surveys. That's only 1 in 4 mortgage brokers. And good luck finding a banker who even knows what that is. I can't tell you I've ever come across someone who works in a bank that does mortgages that knows what the heck that even means. The most truthful situation that I could provide you is that most mortgage advice is outdated assumptions or generic recommendations based on something that was handed down from a sales clause or sales training center 12 months before. Current market conditions require a specialized, at least weekly analysis of the markets and what is happening, which is at bare minimum, in my opinion. I think someone should be looking at the markets on a daily basis, have a framework to helping making a decision, and then apply that framework to their clients. Now, whether you're renewing, buying, or refinancing, my goal is that this framework helps to make better decisions for what the Bank of Canada does or doesn't do on September 17th, whether before or after. And the thing is, it's not about timing one decision perfectly. It's about having a better framework for all of your decisions moving forward. Using this methodology, our clients save money on average per mortgage compared to the conventional term selection. And it's not because of rate shopping. It's because picking the optimal term based on the trends that are available. Now, listen, the jobs data that came out exposed a massive mispricing opportunity in Canadian mortgage terms that most borrowers that are out there, probably yourself, don't even know exist. And this matters because this isn't complex financial theory. It's about real money in and out of your pocket by making a better decision and understanding the data. 86% of borrowers choose terms based on comfort rather than analysis, on what their uncle says rather than a strategy. And it costs them thousands of dollars unnecessarily. And so again, their typical term selection is, where's the cheapest rate? That isn't a term selection. That's like, what's the cheapest car when you need a truck? It makes no sense whatsoever. This mistake isn't inevitable. It is a result of making decisions where people don't understand the marketplace. Knowledge, as you know, is power, but actually applying the knowledge and working with someone who can do this for you is even more impactful. Now, you can take this information and apply it to your own personal financial situation if you'd like to. The thing is, our team and myself, this is what we do and how we analyze our clients' mortgage portfolios on a daily basis for them. If you'd like to apply this information to yourself, please feel free to do so. But if you feel like this information is too much and it's somewhat nuanced and you'd like a team to look out for this for you, then make sure to click on the link in the description below so that my team and I can help you develop a plan that makes more sense for your financial situation. It doesn't have to be complicated or complex, but it definitely needs to be careful consideration. Also, subscribe if this opened up your eyes on how to pick mortgage term selection, and hit that little notification bell if you found this video helpful. I'd appreciate it. Any comments below on what you learned from this video or how you're going to pick your mortgage term coming up would be really interesting for me. Thanks again. I'll see you on the next one.